Yet another critical test of the bond market and demand for US Treasuries. Today, we just had a $13 billion 20-year bond auction. What do the results tell us? So here we can see the results from today's auction. We sold $13 billion of these 20-year bonds. The high yield was the same as the when issued. We can see that despite the strong auction, the 20-year bond yield is actually up 4 basis points on the day. We can see about 18% of the bids were awarded at the high yield, which was the same as the when issued, and primary dealers took down 13%. Here's a brief explanation. I won't go through the entire thing again. This is a Dutch auction. This is how US Treasury auctions work. They are in the style of a Dutch auction. You have a starting price, otherwise known as the when issued. You go down in price or up in yield, right? Because the value of the bond is inverse to the yield, go down in price, up in yield until the entire bond supply is absorbed, until the entire auction issuance is absorbed. Whatever price is needed to get that to happen, to get the entire supply absorbed, that is the final clearing price. The tail represents the variance downward in price or upward in yield. The bid to cover, this is the total issuance divided by the total number of bids, and awarded at high, this is referring to the percentage of the auction that is awarded at the high yield, or put another way, awarded at the low bond price. Here we can see, this has a much larger tail. A tail and a stop through are the same concept, just in different directions. A tail indicates that the price had to move down from the when issued, whereas a stop through indicates the price is actually ended up clearing higher than the starting price. Here are the results from the auction. You can always find announcements and result data on treasurydirect.gov. Here is a zero hedge visualization of the tail versus stop through. He had indicated that there was a mistake here with Bloomberg, which is his data source. This indicates a tail, a very, very small tail, when in fact we established that there was no tail, no stop through. It was perfectly even at the when issued. But generally, I think the take home here is this chart goes back to 2020, and you can see that in recent history, going back about a year to the summer of 2024, this 20-year bond has tailed pretty significantly more often than not. You can see we've had a couple stop throughs here, but in general, this tends to tail and tail pretty significantly. Today, they decreased. The size of the auction today was relatively small at just 13 billion. So that might have avoided a tail in today's auction. Here, remember, this is the composition of the buyers, direct bidders, and orange bars. This indicates, hedge funds, family offices bidding directly for their own firm. Primary dealer, this is a very select few number of very large financial institutions that have a bit of an arrangement with the Treasury. There are rewards and incentives for being a primary dealer, but the expectation is that the primary dealer takes down any and every kind of extra unit that there is not a bid for. So the primary dealers you can think of this as the buyer of last resort. Indirect is generally seen as a way to approximate foreign demand. That is generally who makes up the indirect bidders. Bid to cover, we established this is the total issuance divided by the total number of bids. And the yellow line just indicates the 20-year bond yield. That is what you would find if you looked at Yahoo Finance or TradingView. So the 20-year has some kind of special considerations. Number one, it's a relatively short. The duration itself, the 20-year bond, has only existed for a few years. So here's a 20-year bond yield. We can see that it came into existence in May of 2020. So it's only existed for about 5 years. But the 30-year, the 10-year, those maturities on either side of this 20-year bond, the 10-year and the 30-year have existed decades and decades, going back to like the 80s. So it's a relatively new tenor for the Treasury. And it's kind of like it's seen a bit as kind of a redheaded stepchild by market participants and commentators. They say, you shouldn't look too much at the 20-year bond. It's a weird, it's a relatively new tenor. It's kind of a strange, intermediate between the 10 and the 30, and it is not safe to kind of extrapolate out the results of a 20-year bond auction onto, say, the 10 or the 30. We know the 10 and the 30 actually last week had relatively strong, very strong auction performances, but what changed is Friday we had this Iranian conflict, Iran and Israel geopolitical issue pop up. Oil started to spike. At one point, it was up like 14%. S&P, equity sold off really hard. And what happened is bond yields actually moved higher on that Friday, Friday of last week. We can see that in this case, the 20-year bond yield was up 8 basis points. This is generally not what you see in the face of a very heightened political landscape, geopolitical landscape. Generally, bonds are seen as kind of the safe haven where money flows into. That is not what we saw since the start of this current geopolitical issue. We actually saw bond yields go up, meaning that people were selling bonds. But anyways, back to this kind of idiosyncratic issue. Not only is it a new tenor, and not only is it kind of a weird in between, or at least seen as a weird in between the 10 and the 30. But you also have the TLT. So TLT is an ETF that tracks the long bond, is the main ETF for people that are trying to trade kind of an expression of the long-term bond, whether they think that's going up or down. And that is what we see in the candlestick chart here. This red line indicates short interest, and then these bars at the bottom indicate volume. And so something that you can see is a spike in short interest. If a bunch of people want to express a position of being short on the long bond, meaning bond value down, bond yield up, the main expression of that would be to short the TLT. This is a very, very liquid, one of the most traded ETFs in the entire market. It is kind of the way to express a position on the long bond. So what you have is kind of strange dynamics sometimes between where the 20-year bond yield could actually be higher than the 30-year bond yield, and some intraday dynamics too that if you watch it on an intraday basis can sometimes look a little odd. My theory for this is that you have this super, super, super large ETF, which is kind of the main way that people use to express position on the long bond. And the TLT just so happens to be the 20-year. The main holding of the iShares 20-year bond ETF is 20-year bonds. So sometimes you can get some kind of strange dynamics, in addition to the fact that it's a relatively new tenor and kind of a strange in between between the 10 and the 30. Here is the 20-year bond yield minus the 30-year bond yield. Generally, you would expect the 30-year to be higher. You would expect this generally to be negative. And we can see that it was, very briefly that day in 2022. But in general, it's actually been inverted, where the 20-year bond yield is actually higher than the 30-year bond yield. This is not what you would expect. You're taking 10 years extra in terms of risk if you're in the 30-year. So generally, you would expect this to be going the other direction, where the 20-year bond yield is actually lower than the 30-year bond yield. But that's not what we see. We see kind of a bit of a inversion where the 20-year yield is actually higher. Again, I think that this is due to the TLT and tens of billions of dollars being able to be expressed in a short long bond position, which is kind of generally speaking what we see sometimes with these big short interest spikes and these big volume spikes. Just this one day in April of 2025, you had 125 million shares being traded. Each share at the time was about $90. You could multiply that out. It's a huge amount of notional value being expressed through the TLT. And so you can get kind of strange dynamics sometimes. Here is the TLT and a non-total return. Here is the total return. You can see that even with dividends, it's not the prettiest looking chart. I did want to just always point out, anytime I'm talking about the TLT, I want to point out that TLT has been in a very significant bear market when you do a cross with gold. So here's TLT divided by gold. As this line goes down, gold is outperforming TLT. You can see that even when you adjust for the total return, when you adjust for dividends, even when you do that, it's a pretty ugly looking chart. The same is true for the S&P 500, very ugly looking chart. And then Bitcoin, these are logarithmic charts, by the way, and you can see that it is even uglier when you take TLT, the long bond, and denominate it by Bitcoin. I did want to mention just briefly, so we mentioned on Friday that we saw bond yields, especially at the long end, moving higher, meaning bonds were getting sold. The value of the bond was moving down. This is generally not what is expected in a time of heightened geopolitical issues, especially for American bonds. Generally speaking, you would expect the bond yield to go down on a day like Friday when oil was up at 1.14% on these kind of heightened geopolitical tensions. And we see a continuation of that trend with higher yields. The 30-year, the 10-year, and the 2-year are all up on the day. The 30-year is up, another 6 basis points. So you add that to the move that we saw Friday. That is not an insignificant move in the 30-year bond, and you would expect it to go the other direction, given kind of the geopolitical issues. But that's not what we've seen. We've seen yields move up. And we can see equities are up on the day. They rallied on a Wall Street Journal report that Iran was trying to kind of restart negotiations, de escalate the situation. We can see it starting to give some of that back. Volatility had come in, again, kind of starting to retrace some of that move. Oil, I think, is notable. Oil is now lower than Friday's close. We can see Friday's close was about $73. Currently, WTI is trading at $71. The dollar is the other thing I would say to keep an eye on. The dollar was looking like it was going to break that low that was set Thursday and Friday. It was looking like it was going to break down. It was moving pretty sharply lower earlier today. It has bounced, but I would say kind of watch that 97.70-ish level. If it breaks and makes a new low, I think that would be notable, especially with bond yields moving higher. This goes to our kind of the concept of repatriation and the move away from the long bond that we've been talking about. The other I mentioned very briefly, I'll just finish, when it comes to the issuance schedule, how much of US debt is issued at the 3 month or the 6 month or the 2-year or the 30-year, right? That issuance schedule, under the prior administration, they recognized that foreign demand for the long bond, not only foreign demand for the long bond, but demand in general was pretty poor. And so what the prior administration under Yellen started to do is shift issuance much more to short-term bills, say like a 3-month Treasury bill, and away from kind of the way we used to do it, which was trying to spread out our issuance over many different durations. This gives the government kind of a buffer where if inflation were to spike, say due to oil going to $100 a barrel or something, if inflation were to have a near-term spike and the Fed had to hike rates, if you spread your issuance out the way we've done it for many decades, you would be okay because you were able to issue a bunch of very long-term debt that you don't need to worry about refinancing for, say, 10, 20, 30 years. You already locked in the interest rate. If the Fed has to take rates higher for a year or so in order to combat rising inflation, they're able to do that without a huge impact on the interest expense for the government. Well, that's not the situation we find ourselves in now. We have shifted so much issuance towards very, very short duration debt that needs to be rolled, right? The downside to that is every 1 month or 3 months or 6 months, you have to roll that debt. When the debt comes due, we do not actually pay it back with, say, tax money. We issue new debt to get dollars to pay the old debt holders back. And so you're constantly in a cycle of refinancing. Well, if you've shifted a huge amount of issuance towards the short end of the yield curve, you are much more sensitive to kind of short term sort of fluctuations in the overnight interest rate set by the Fed. We do have a Fed meeting this week. There will be a new SEP, which is this summary of economic projections. This is the dot plot that people talk about. We will be getting a new one of those at the Fed meeting this week. So we will definitely do a video on that when it comes. But until then, I would say, watch the long bond. Bond yields should not be moving higher, especially with a strong 10-year bond auction last week, strong 30-year bond auction last week, very significant geopolitical issues going off in the Middle East, and another strong 20-year bond auction today. The past couple of days, you would not expect bond yields, especially at the long end, to be moving higher, yet that is what we see. So I would say keep an eye on that. I would say if you're trying to kind of evaluate the likelihood of de-escalation versus or escalation in the geopolitical issues, I would say watch oil. And then finally, keep an eye on the dollar. If it breaks that kind of 97.60, 97.70 level, I would say that that's probably pretty significant because, again, in general, when we are in a world with kind of very heightened geopolitical issues, you generally expect the dollar to rally. And it tried to on Friday, but it was pretty pathetic. And today, was looking like it was going to make a new, 4-year low. The last time the dollar was at these levels, the dollar has not been this low, especially given kind of the geopolitical issues going on. The dollar has not been this low going all the way back to April of 2022. So I would say also keep an eye on the dollar. If this breaks and makes a new low in the face of these heightened geopolitical concerns, you see bond yields moving up, as we were looking at. You see oil moving up. It's not a good situation to find yourselves in if you're the U.S. government. So, anyways, hopefully that was helpful. And if you want a full explanation for how the bond auctions work, I would say check the 10-year and the 30-year video I did last week. Those go into a little bit more, spend a little more time on it. But anyways, hopefully that was helpful, and we'll see you later this week after the Fed meeting.